Hi everyone, Bryn here with another episode of Financial Frustrations, presented by Metherell Financial. Today's frustration is mortgage insurance. Who's really being protected? Spoiler alert, if your mortgage insurance is with your lending institution, you might not like the answer. But there is a better idea: individually owned life insurance provided by a licensed insurance advisor. To help explain the difference, let's meet Phil and Wendy, who just bought their first home with 20% down at the ages of 31 and 28, respectively. They went to their lending institution and took out a mortgage of $500,000. Their lender encouraged them to get mortgage life insurance, which costs $156 per month and gets added to their monthly mortgage payments. Now let's fast forward 8 years and 2 kids later, and unfortunately Wendy passes away. Phil remembers about the mortgage insurance, so informs his lending institution of this tragedy. At this time, his mortgage balance is approximately $325,000. The bank does their due diligence and doesn't find any reason to deny Wendy her coverage. For example, if there was a pre-existing condition that she had failed to disclose. The $325,000 is paid to the bank and Phil is now mortgage-free. Let's rewind the story to when Phil and Wendy bought their first home. But instead of getting mortgage life insurance, they went to a licensed insurance advisor and purchased individually owned life insurance. They each took out a policy for $500,000 of coverage with a 20-year term to match their mortgage. This cost was only $54 a month. That's less than $2 a day or the cost of your daily coffee. Unfortunately, their story still includes Wendy passing away in 8 years, but this is where the story changes. Wendy was able to list Phil and her children as her beneficiaries, not the bank. Furthermore, Phil received the full $500,000, not just the $325,000 of the outstanding mortgage. Phil was able to use this money to cover funeral costs, pay off the mortgage, open an education fund for the kids, and take time off work to grieve and adapt to their new lives. This alleviated the financial stress and gave Phil peace of mind knowing that he had the funds needed to help carry his family through this tragedy. Plus, Phil still has the $500,000 of coverage on himself if the unthinkable were to happen to him too. I think it's obvious which protection option is the clear winner here. Individually owned life insurance is more affordable, has greater options, and puts the money in the hands of your loved ones, not your lender. Now I know this isn't a topic people like discussing, but Phil and Wendy are real people. Wendy passed away at 41, leaving behind Phil and their 5 and 7-year-old children. Phil has said many times, I don't know where we would be today if it wasn't for that policy. So if you have a mortgage and/or children, I encourage you to speak with a licensed insurance advisor. I know you'd do anything for your family, so please do this. Click the link below and set up a quick 15-minute call to discuss your needs. No sales pressure, just information. We've helped hundreds just like Phil and Wendy get the coverage they need, and we can help you too. Well, that's all for this episode of Financial Frustrations. If you've got a frustration you'd like addressed, please submit it below.